Stop what you're doing, seriously. If you own ArcBest, or honestly, any transportation stock, you need to hear this financial breakdown right now. Last week, I ran ArcBest's Q1 2026 earnings through 5 different fundamental valuation models and 2 legendary investor checklists. And what I found? It literally shocked me. On the surface, this stock is a massive walking contradiction. Think about this. This century-old logistics giant just hauled in nearly $1 billion in a single quarter. They actually grew their top line by over $30 million, but somehow they managed to post a GAAP net loss. I know the exact fear that keeps retail investors like us up at night, right? It's the absolute terror of buying into a heavy, cyclical freight stock right before a broader market downturn completely crushes their profit margins. It's terrifying. It makes you wonder, if we looked at this through the eyes of the absolute greats, would Peter Lynch see this as a classic textbook value trap to avoid at all costs? Or would Warren Buffett look past that temporary bleeding and see a deeply hidden economic moat that Wall Street is just totally mispricing? Currently, institutional ownership sits at over 99%, and analysts just upgraded it to a strong buy. So wait, who's actually right here? The surface-level negative earnings, or the big money that's quietly loading up the boat? The answer lies in a brutal margin squeeze that's happening right now, which is being actively countered by a massive, multi-million-dollar AI strategy. How exactly does a company move more physical weight, increase their daily shipments, and still make less money doing it? And more importantly, how on earth are they fixing it? By the end of this explainer, you're going to have a crystal-clear, actionable framework to see exactly how ArcBest is positioning for a massive rebound, and you'll know for sure if this is a Buffett-style buy or a Lynch-style trap. Welcome to this explainer breaking down ArcBest's Q1 2026 earnings, where we're going to unpack the wild paradox of a logistics titan growing its revenue while facing a serious squeeze on its profits.
Here's a quick look at our agenda for this explainer. First, the Q1 earnings paradox. Second, asset-based, heavy but expensive. Third, asset-light, a profitable turn. Fourth, tech, AI, and efficiency. And finally, the road ahead. Let's jump right in.
Section 1. The Q1 earnings paradox. Top-line growth meets bottom-line pressure. Let's dive straight into this contradiction that totally defined the first 3 months of 2026 for ArcBest.
To start, you have to respect the legacy here. Founded way back in 1923, ArcBest employs around 14,000 people across 250 campuses today. So this century-old, multi-billion-dollar logistics powerhouse obviously continued to move a massive amount of freight across the country this past quarter. But the current economic environment, it presented some really unique, heavy challenges.
And that brings us to the core conflict of the quarter. Check this out. Despite bringing in nearly $1 billion in revenue, specifically $998.8 million, which is actually a 3.3% increase year over year, ArcBest somehow posted a GAAP net loss of $1 million. I mean, how does a company grow its sales by over $30 million but flip from a profit to a loss?
Well, there's always more beneath the surface. When you adjust for one-time charges like their really heavy investments in innovative tech and some purchase accounting amortization, their non-GAAP earnings per share actually hit 32 cents. And guess what? That comfortably beat Wall Street's expectations of 29 cents. So yeah, they lost money on paper, but operationally, they're actually executing better than the analysts predicted.
To understand exactly where all that profit went, we need to look closely at their largest division. Section 2. Asset-based, heavy but expensive. The realities of physical freight.
So, the asset-based segment, which operates their core company-owned less-than-truckload fleets, this is essentially the actual physical trucks and drivers, makes up the lion's share of their business. It brought in a whopping $655 million this quarter, compared to $378 million for the asset-light side.
But here's where it gets really fascinating. Physical daily tonnage actually grew by a robust 6.5%, and their shipments per day were up too. Yet, the segment's operating income plunged by nearly 34%. They are literally doing more work, moving more weight, but making significantly less money doing it.
Why? Well, the margin squeeze came from very real, unavoidable physical headwinds. Early in the quarter, they faced severe winter storms. Then you had higher labor costs from union wage increases, spiking diesel fuel prices, and a shift toward a heavier freight mix. And that heavier mix actually lowered their revenue per hundredweight. It's a classic squeeze. Your costs to operate go up, but you get slightly less revenue for every pound of freight you move.
But while the heavy trucks were taking a beating from those headwinds, the other half of the business tells a completely different story. Section 3. Asset-light, a profitable turn. Agility in a fluctuating market.
Let's define this real quick. The asset-light segment focuses on managed logistics, brokerage, and expedited services, but without owning the actual trucks. Instead, it relies on third-party carrier capacity. This is huge because it gives ArcBest the agility to adapt rapidly to changing market conditions without being weighed down by the massive fixed costs of a giant fleet.
And their productivity gains here, honestly, brilliant. Shipments per person per day improved by a massive 26% year over year. Just think about that from an efficiency standpoint. Your team is pushing through over a quarter more volume per person than they were just 12 months ago. That is a game changer.
Because of those insane efficiencies and a record performance in managed solutions, we get a complete reversal. The asset-light division swung from a $4.4 million operating loss last year to a solid, albeit small, operational profit of $200,000 this quarter. They're proving they can actually scale profits here, even when the broader freight market is completely tenuous.
So the absolutely crucial point is how ArcBest is fighting this margin squeeze across the entire company. Section 4, Tech, AI, and Efficiency, Modernizing Legacy Logistics. Their weapon of choice, you guessed it, technology.
But they aren't just throwing around AI as a buzzword for investors. They're actually deploying it practically. They secured $32 million in annualized savings just from continuous improvement training, and another $15 million directly from AI-enabled city route optimization. That's real money. They're applying these tools to genuinely improve decision-making and lower the cost to serve.
Building on that momentum, May 2026 brings the launch of ArcBest View. This is a unified cloud-based platform for quoting, booking, and tracking that just massively enhances the customer self-service experience. It's all about creating an intuitive interface to help customers manage really complex supply chains, which of course drives more volume straight through ArcBest network.
All right, let's move to our final section. Section 5, the road ahead, positioning for the market turn. Let's see how this strategic tech buildup actually positions ArcBest for the remainder of 2026 and beyond.
CEO Seth Runser is remaining incredibly confident. He acknowledges the environment has been unpredictable for a while now, but insists their core strategy is totally sound. He emphasizes that they've positioned the company for significant operating leverage. Essentially, what he's saying is that when the broader market cycle finally turns around, ArcBest is coiled like a spring, completely ready to capture massive margin expansion.
And management's forward guidance actually backs this up. They're projecting sequential profit improvements for Q2, expecting the asset-based operating ratio to improve by a really healthy 400 to 500 basis points. They also see the asset-light operating income jumping up to between $1 and $3 million. So why all the optimism? Well, macroeconomic indicators like the manufacturing PMI have moved into expansion territory, and truckload capacity is finally showing early signs of tightening as excess supply leaves the industry.
In the market, it definitely seems to be noticing this underlying structural strength. Analysts like Zacks Research recently upgraded the stock to a strong buy, and institutional ownership is sitting firmly at over 99%. That tells us the big money deeply believes in this turnaround strategy, totally looking past the short-term earnings pressure.
As the logistics industry navigates this highly complex environment, we have to ask ourselves the million-dollar question. Will these strategic tech investments allow ArcBest to turn their current top-line growth into massive profit margins when the freight cycle fully rebounds? I mean, they've got the tonnage, they've got the tech, and they definitely have the agility. Now it's just a matter of execution. Thanks for joining me on this explainer, and definitely keep your eyes on how these supply chain shifts play out.